everyone, and welcome back to a new episode of JustDario Cigar Time. In today's episode number 35, we are tackling what Wall Street is whispering about in elevators, and hedge funds are already dissecting in their control rooms. 0 days to expiration options risk, or 0 DTs. Imagine a financial instrument that lives and dies in hours. A $1.5 trillion a day market growing like radioactive algae. Some call it ingenious. Others see a doomsday device. We will unpack why these ultra short-term derivatives are the canary in the coal mine for global markets. Start with the basics. Imagine you are betting whether the S&P 500 will rise or fall before today's closing bell. That's a 0 DT option, a contract that expires worthless or pays out in mere hours. Think of it as a lottery ticket that self-destructs daily. Back in 2016, these made up just 5% of S&P 500 index options. Today, they are a seismic 61%. That's 1.8 million contracts traded daily, up 500% since 2022. To grasp the scale, every single day, traders gamble the equivalent of Apple's entire market cap. It is roughly $3 trillion on these intraday options on the S&P 500 index alone. Make an example now with 3 players to help you better understand what are the dynamics of this key instrument. The first one is retail trader Sarah. Sarah wakes up to the news of a cooler than expected inflation data. Instead of buying stocks, she spends $47 on a S&Px 0DT call option at 9:30 a.m. By noon, if the S&P 500 rallies 1.5%, her $47 become $1,100, like turning the deal for a lunch into a rent check, effectively. Player is the hedge fund Volta Capital. Volta owns $500 million worth of tech stocks. Fearing a Fed announcement as a result of the data, 0 DT put options as an insurance for 0.3% of their portfolio value of roughly $1.5 million. If the market goes down 3%, those puts will surge 300%, offsetting eventual stock losses. The player number 3 will be the asset manager White Rock. White Rock wants leverage exposure on the NASDAQ without borrowing. The solution? They buy 0 DT call options controlling $100 million in notional value for just $800,000. If the NASDAQ jumps 2%, they pocket $2 million, 150% return in hours. Fuel of all of this? Clearly exploding volumes. In Europe, Eurostoxx 50 options saw 0 DT trading grow 1,200% since 2020. In Japan, Topic's 0 DTs now make up for 40% of all derivatives volumes. This isn't anymore just a niche gambling. It's a complete rewiring of the market structure. Let's meet the puppet masters, market makers. These firms, think about Citadel or Jane Street, are pretty much the casino operators. They take bets, but they despise the risk. Let's take a look at how a hypothetical market maker called Delta Traders would operate through a typical trading day. At 9:31 a.m., the retail trader Mike buys S&P 500 0 DT call option from Delta Traders for $500. Instantly, Delta Traders' risk system flashes red. Why? If the S&P 500 rises, Mike's profit, meaning Delta Traders loses. Their solutions? Delta hedging. Within milliseconds, Delta Traders buys $82,000 worth of S&P 500 futures. Now, if the index rises 1%, Mike's $500 call gains $420. But Delta Traders futures gain $820, netting a $400 profit. It's like a baker selling birthday cakes, but at the same time hoarding flour to hedge against wheat price spikes. At 10 a.m., orders flowed in. For every 100 call buyers, Delta traders sees 95 put sellers. They pocket the bid-ask spread, let's say $0.10 per $400 worth of contract, on thousands of trades. Meanwhile, their quant models calculate the net exposure, the leftover 5% of unbalanced bets. To neutralize this, they trade futures, but cautiously. On a normal day, 0DT hedging moves S&P futures by just 0.04%. That sounds like a ripple in an ocean. There is a paradox. This delta hedging stabilizes markets. A Bank of England study found 0DT flows reduce intraday volatility, usually by 60 to 90 basis points. Imagine turbulence on a flight, smoothed by counteracting winds. What's effectively happening here is a consequent volatility suppression in the market due to this dynamic. Consequently, it should not come as a surprise anymore that with the ballooning of 0DT option volumes, volatility indicators like the VIX are more and more trading well below their structural long-term averages. There is a big problem a market maker has to constantly deal with: gamma exposure. At 3 p.m., if the S&P suddenly drops 1%, Delta traders must sell futures to rebalance, and market makers all sell simultaneously. They clearly amplify the move. On May 31st, 2024, a similar dynamic caused a so-called gamma stomp, and the S&P 500 slid 1.8% in merely 20 minutes. Now that the dynamics are clear to everyone, I would like to simulate a doomsday scenario. Let's imagine it's October 17, 2025. Overnight, the US president announces out of the blue a 50% tariffs on all Chinese imports, and panic erupts. 30 a.m. Eastern Time, US markets open. S&P 500 futures gap down 3%. Normally, 0DT traders would swarm, but today, buyers vanish. Volume collapses 80% in 10 minutes. Why? The fear of pin risk. That means getting trapped in expiring contracts. It's like musical chairs where everyone suspects the music is about to stop. At this point, dominoes start to fall. Domino 1, market makers. Delta traders holds 50,000 unhedged put option shorts. With no sellers, they can't offload risk. Their only escape, dump $4.1 billion in S&P futures. But when every market maker does this, liquidity vanishes. And here we go. Futures plunge 5% in 10 minutes. That's effectively a flash crash on steroids. 2, brokers. Let's assume we have a broker called Trade Zero that offered clients 20-to-1 leverage on 0DT options. As Apple stock, that is heavily traded by 0DT option, collapses in this situation by 7%, instantaneously, tens of thousands of accounts blow up. Trade Zero's automated system triggers mass liquidation and starts dumping hundreds of millions of dollars in stocks in the open market, worsening the plunge. Number 3, asset managers. The hedge fund Volta Capital used 0DT puts to hedge $2 billion in tech stocks. But with options frozen, their insurance effectively evaporates and they start facing margin calls. So what do? They start fire selling, for example, their NVIDIA shares. That starts crashing in prices. Domino number 4, ETFs. Market makers had suppressed volatility via 0DT hedging, as we discussed before. But now the VIX suddenly spikes above 60. And this triggers vol control funds to dump, let's say, $70 billion in equities. 11 a.m., a feedback loop ignites. Falling stocks force more edging sell-offs. And the New York Stock Exchange halts trading because circuit breaker starts triggering left and right. I think that the scenario I just described is totally unrealistic. in reality, we already came very close to such a situation in August last year, when at that time, the Nikkei was falling 9% during overnight trading hour for the US, at some point falling more than 12%. And I would like to remind everyone, the hedge funds, traders, and brokers started to hedge volatility and all their risk well before cash trading opening the S&P 500, with the VIX future exploding above 60 before market open. So clearly, we are very, very close to a situation where things can completely go out of control. But here, I would like to now analyze, when does this zero DT option market can potentially trigger a catastrophe? In my opinion, that will happen with a very high probability when we are going to reach the 70% volume threshold. And right now, zero DTs already make up 60% of S&P 500 options alone. Imagine if they hit 70%. This will force delta hedging that could exceed 5% of daily future liquidities. And this volume is enough to fracture markets. At today's volume, a mere 15% imbalance would require $125 billion in emergency trades. And just to give you a comparison, that will be equivalent to when Lehman Brothers collapsed in 2008. Of course, in this kind of situation, we will likely see regulators stepping in, as it has already happened. For example, there could be a cap in the total position that a single firm can take in zero DT options. And we already had an example in 2024 when the Osaka exchange crashed and Japan capped single firm zero DT position at 100,000 contracts. A second tool will be circuit breakers, but not only on single stocks and indexes, but also zero DT trading. If, for example, the S&P 500 drops more than 5% in an hour. Another tool that regulators can use will be suddenly imposing a margin overall. For example, in Europe, they are already discussing to require brokers to collect 80% of collateral on zero DT leverage trades. So basically, people will not be able anymore to rent $1 million worth of exposure on a trade, just pay $10,000 in premium. So to conclude, is the Canary still breathing? Yes, it is, for now. But its wings are straining under $1.5 trillion of daily bets. Zero DT options aren't evil. They are tools reflecting traders' hunger for speed and leverage. So the solution isn't banning them, but engineering resilience instead of letting everything running wild as it is happening today. And personally speaking, I don't expect regulators to take any preemptive action before real chaos will start hitting the tape. This is why it is very important to be mindful of this whole situation, because effectively we are heading towards a scenario where a flash crash like the one experienced in 1987 can occur again, despite all the tools and circuit breakers today potentially in place to avoid that. Avoid in theory, because as we experienced many times, for example, with the flash crash of 2010, high-frequency trading funds were actually much faster than the circuit breaker. And we saw stocks like, for example, Procter & Gamble crashing in minutes, like more than 40% or so on. Of course, at that time, zero DT options were not the problem. But here is a clear example of how tools set in place in a completely different market structure can fail to prevent a dangerous and catastrophic feedback loop in an environment that is completely changed, with all the potential consequences beyond just a flash crash, because you can imagine the impact on capital, liquidity, panic, and so on, in particular considering how inflated are stocks valuation today, especially in the US. A lot for listening to my new episode today, for liking the video, for subscribing to my YouTube channel, for supporting me on X, and for reading my blog articles on JustDario.com. Before concluding, I would also love to remind you of the offer to access Synnax risk platform that I helped to develop with my colleagues and team at Synnax, 1 month free in order to access cutting edge risk tools and predictive risk scenario that can help you navigate all these markets. And after the 1 month free, it will only cost less than a cup of coffee per month. Thanks a lot again, and I wish everyone a nice week.